SIPs or systematic investment plans have become a household name in India. There are good chances that you have a few going as well. The reason for this popularity is quite obvious. They are a convenient way to build wealth with small and regular contributions. So you're essentially putting your wealth creation on autopilot. But are there strategies that can enhance your SIP returns? For example, what if you did a weekly SIP and not a monthly SIP? What if you did a SIP on a particular day which gets you best returns? What if you did your SIP only during market falls? In this video, we will answer these questions. But before we start, do subscribe to our channel and press the bell icon so you never miss a video from us. Today, we will discuss these 4 questions that many SIP investors like you may have in the mind. Number 1, how frequently should you do your SIPs? Should you do it monthly, or are weekly and daily SIPs more rewarding? Number 2, what is the best date for SIPs? That is, can having a specific month date for SIP lead to better returns? Number 3, is buying only on market dips better, or is simply investing via SIPs good enough? And lastly, we will look at a question that are SIPs always more profitable than lump sums, or are there cases when they are not? Okay, if SIPs are good, shouldn't you do more of them? If monthly SIPs are working well for you, wouldn't weekly or even daily SIPs be even better? Theoretically, when you invest weekly or daily, you will get better price averaging as markets go up and down every day, and you will benefit from most of those movements. But is that true? To find the answer to this question, we calculated the returns of daily, weekly and monthly SIP in Nifty 50, Nifty Mid Cap 150 and Nifty Small Cap 250 indices. Now, as you can see on your screen, in all the cases, the SIP returns are almost the same. It didn't matter if you did daily, weekly or monthly SIP. So there is little to gain by doing weekly or daily SIP. But by increasing your SIP frequency, you get something extra in life, which is extra effort to manage them. Here is why. Most platforms don't allow weekly or daily SIP option. That means you will have to do them manually, or you will have to run multiple monthly SIPs, each for the specific day of the month. And that can be quite a task. And also means you will have to have a bigger transaction record to manage. To add to it, calculating taxes becomes even more cumbersome as each SIP contribution is taken as an individual investment. So every time you have to make a redemption, you have to figure out the tax implications and how to best optimize for it. With monthly SIPs, you keep things simple. Your frequency of investment is aligned with your income frequency and you invest as your income comes. So net, stick to your good old monthly SIPs. Let's take the next question. What is the best date for SIPs? Does it matter on which date of the month do you do your SIPs? Well, many of us would do our SIPs in the first week of the month after we have received our salaries. But what if a date later in the month is more fruitful? Let's find out. Take a look at this table. It shows you the returns you would have made by doing SIPs in the Nifty 50, Nifty Mid Cap and Nifty Small Cap indices over 10 years on different days. The highest and the lowest returns have been highlighted. A quick look suggests that there is hardly any significant difference in the returns. This means it doesn't matter when you do your SIPs. So your convenience is the only factor that should determine when you do your SIPs. This brings us to the third question. Do SIPs done on market dips generate better returns? What will be your answer when somebody asks you this question? Does buying on dips help you generate better returns? Of course it does, you may say, and let us tell you right away that you are not wrong. But let's see if the data tells us the same thing. For a scenario, let's define a dip as a fall of 2% from the previous day's closing price of the Sensex. Now between March 2013 and March 2023, there were 121 such instances. Also for practicality, we assume that one invested the next day of the dip. We are taking this assumption because it would not be possible for most of us to invest on the same day, especially for those taking the mutual fund route. Alright, with these assumptions, let's see what the returns will be if we invested 5,000 rupees in the Sensex at each dip. The returns of 12.95% look quite good. But let's compare it with the returns with normal SIP returns. As I said at the start of this section, you would not be wrong to think that buying on dips would generate better returns. So there you are. But before you start thinking about junking your SIPs, hear this out. The buying at dip method has a rather serious problem. It requires you to invest actively based on market movements. So you need to be on top of the market, that too for a very long time. That's simply not true for most of us. I mean, we can show you the data in hindsight, but when it comes to doing in reality, it's equivalent to moving mountains. But what if you combine your regular SIPs with buying on dips? Well, as you can see on your screen, you can bump up your returns quite significantly. So continue your normal SIPs, as that will be sufficient to get you to your goals. And whatever dips you can buy, you will create some alpha on your returns. And if you miss a few or all the dips due to lack of cash or not keeping track of the market, it should be okay, as your goals don't depend on it. Are SIPs always more profitable than lump sums? What's your guess? Are they really? Being SIP fans, we would like to believe they are. But does data also tell the same story? Let's look at it. Now let's say you did SIPs in Nifty 50 between October 26, 2008 and October 26, 2015. Here's how your returns would compare to a lump sum investment made at the start of the period, that is October 26, 2008. During this period of 7 years, SIP would have given you fewer returns than the lump sum investment. Now, why did that happen? Let's look at the Nifty 50 chart during this period. As you can see, Nifty 50 has moved up during these 7 years. So most of your SIPs during this period just averaged your overall cost upwards. Hence, lump sum investment did better as you invested at a lower level. Now let's look at another period from January 6, 2018 to January 6, 2015. What happened during these 7 years? See the chart on your screen now. Here, SIPs did really well, generating an average annual return of 14.22% as compared to 4.9% of the lump sum. To find the answer, let's look at the Nifty 50 movement during this period. A deep correction during these 7 years allowed SIP investors to average their overall buying price lower. But lump sum investors couldn't take advantage of this dip unless, of course, they did invest more during the dip. Now, what do these charts show? Whether SIPs do better than lump sum or vice versa is a function of market condition. It's not that one is better than the other. Actually, both of them are just investment strategies. The table on your screen will add to your understanding. It shows the returns of SIP and lump sum investment made during several periods. Of the 14 instances, SIPs did well in 7 and lump sums did well in 7. So it's a neat tie. So don't expect your SIPs always to beat lump sum or vice versa. Alright, now let's summarize what we learned in this video. While everyone would want to optimize their returns, the frequency of SIP or a particular date of the month has limited bearing on your SIP returns. What matters is that you invest and stay invested in the market for the long term. Investing only during the market falls is a tempting proposition, but unfortunately it's not practical. Not only will you have to keep some extra cash all the time, but you will also need to track the markets constantly. That's like doing a second job apart from one many of us already have in our hands. So a simple monthly SIP on any date of the month can give you peace of mind while helping you accumulate wealth without making any extra effort. Whether SIPs do better or lump sums depend on the market conditions. SIPs are a convenient way to invest, but lump sums are not bad either. However, it is better to avoid lump sums if you are uncomfortable with the markets going down soon after you make the investment. With this, we have come to the end of this video. If you like this video, do share it with your friends and family, and don't forget to like it. And stay tuned for more insightful videos from us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.